Hi, let us now look at metrics and measurement in SaaS companies. Since SaaS is a subscription business, recurring revenue is a very important metric. So, ARR, annual recurring revenue, which is the current month revenue multiplied by 12, is a critical metric. Or it could also be MRR, which is current month revenue, monthly recurring revenue. To realize the revenue in future, any changes in customer base, either number of customers or revenue from customers, any changes to that makes a significant impact. This is a typical characteristics of SaaS business. So we will talk about how revenue repeats over the life cycle of the customer. So the repeat revenue is a function of multiple factors. So you start 1 month with a certain revenue. Then what happens to that revenue? Depending on any expansion that takes place, that means more number of users getting added or the same users adding additional modules, paying additional amount of money, there is an expansion revenue, either on number of users or the number of modules per existing user. So that adds to the existing revenue. Then you could also have the reverse. You could have contraction. Suppose the number of employees in your customer organization has gone down, the number of users may go down. So that leads to contraction in revenue. Contraction can also happen because some of the modules are not being used anymore, and so the number of modules subscribed reduces. So you have a existing starting revenue, you had expansion or you had contraction. And another factor could be churn. It could be that some customer or client has stopped using your software. Either the customer has shut down or he has moved to a competitor, in which case that is called a churn. So you have started with a certain revenue, existing revenue, you had expansion possibilities, you had contraction possibilities, and you had churn where the person actually leaves. Finally, these determine what your repeat revenue is. But that's not all. From the previous churned customers, some of them you may be able to resurrect. They start coming back, either because they have started operations again after shutting down, or because they tried a competitor, they didn't like the services of the competitor. That is called resurrection. So your future revenue, repeat revenue, depends on starting revenue plus expansion minus contraction minus the churn and plus surrection that happens. So all this results in the net revenue retention, which we will talk about. Net revenue retention. This is the most important metric in a SaaS business model. What is it? The starting monthly revenue rate plus expansion minus contraction or downgrades minus churn. When you divide that by the starting monthly retention rate, that is called net revenue retention. Ideal net revenue retention rate is 109%. What does 109% mean? That means the customer spending on your company is growing faster than the churn. Another metric related to it is the capital efficiency. You would obviously be running marketing campaigns, you would be paying salespeople to sell. So the capital efficiency refers to total cash burned in terms of sales and operations and overhead divided by the annual revenue run rate. The closer it is to 1, the better it is, or ideally below 1. What does that mean? For every rupee or dollar you burn, you add additional dollar of new annual revenue run rate. That is an ideal situation. So once again, summarizing, net dollar retention is starting revenue run rate plus upgrades minus downgrades minus churn divided by starting MRR. Net dollar retention, anything which is higher than 100 is positive and good. Let's take an example. Your starting monthly run rate is $6,000. Your downgrade, churn and upgrade are 400, 500 and 3000. Let's take a minute to understand this. Downgrade is 400. What does that mean? That means people who are using your software, they are paying you $400 lesser because they are not using some modules. Their volumes has come down. Churn is $500. That means customers worth $500 have left your organization. They are not going to use your software anymore. Either they have shut down or they are using some other alternative software. So you have to, $400 is down because of less usage, $500 is down because people have moved out. And upgrade is $3,000. That means existing people who are using it have purchased more modules, are using the software more. So you're getting $3,000 more from additional usage from your existing customers. So what is your net dollar retention run rate? $6,000 that you started with, plus $3,000 which is the addition, minus $400, minus $500, divided by the original starting number of $6,000. This comes to 135%. Now, is this a good rate? Yes. Any net dollar retention rate above 120% is great. 135% in the SaaS industry is considered excellent. Businesses can track NDR to help them reach hyper growth, gain success, and actually use that to raise more money at a higher valuation or go IPO. Right? A Crunchbase survey revealed that NDR of organizations that have successfully launched IPOs is just below 107% on the average. So if your NDR is above 120%, you have done a great job. Irrespective, a healthy SaaS company should maintain an NDR of over 100%, since that means upgrades are outweighing downgrades and churn. Let's look at some of the key metrics and KPIs in SaaS other than this. One, we talked about monthly recurring revenue, MRR, measures the predictable revenue generated from monthly subscription. Churn rate. This represents the percentage of customers who cancel their subscriptions within a given period, indicating customer retention and satisfaction. So last month you had 100 customers, this month you had 90 customers, your churn rate is 10%. Third is customer lifetime value. This estimates the total revenue expected from a customer over the entire relationship with the SaaS company. So this is a function of what the churn rate is. You will be able to calculate the customer lifetime value from the churn rate that we discussed earlier. Then you have customer acquisition cost. One is the lifetime value, how much money you make from them. Second one is how much money do you spend to acquire the customer. This is called customer acquisition cost or CAC. The cost of acquiring a new customer, you take all the cost you spend, marketing, advertising, sales, and even onboarding expenses, people who help the customer use the software. All of that comes under total cost of acquiring the customer. Divide by the number of customers you have acquired, that comes to CAC. And another metric is customer satisfaction and net promoter score. That measures how happy the customer is, what is the customer loyalty. That reflects on the quality of the SaaS product, overall customer experience. Remember, this is important because the customer satisfaction is not good, the customer will leave. It leads to churn. When it leads to churn, your NDR drops. Your NDR drops, your valuation and your attractiveness as a business will drop.